Hello, everybody. Can you hear me okay? Okay, good. We're going to kick off round 2, the afternoon session of our research challenge. My name is Deb Cook. I'm one of the co-chairs of the event. I'd like my peers, Maura Murrahy and Larry Lannis, to wave and show themselves. We have 4 teams left to present this afternoon. We had 5 teams this morning. The CFA Institute Research Challenge offers students the unique opportunity to learn from CFA leading industry experts and compete with peers from the world's top finance programs. This educational initiative promotes best practices in equity research among the next generation of analysts through hands-on mentoring and intensive training in company analysis and presentation skills. We started our competition this year in October with a presentation from Kylie Rollins, who is the investor relations executive at Ulta, which is our featured company. At the start of this year's competition, there were 12 teams, and we had 9 teams in total that are presenting today. I want to make sure to thank all of our CFA volunteers. This competition would not even be able to exist without so many dedicated professionals that help us every year. We have a bunch of investors who are mentors to our teams, industry mentors. We have another handful that are graders for the research reports. And as I mentioned, you know, this is a fun competition, but it wouldn't be able to happen if we didn't have so many dedicated CFA professionals. And we have 5 more right over here. Our lovely judging panel today. We have Joe Borman from Fitch Ratings. We have Aaron Lash from Morningstar. John Leo from Northern Trust. Alan Meter from Duff & Phelps, and Kwesi Smith from William Blair. So thank you all. We appreciate your participation. Before we move to the presentations, I want to mention a couple of things. First of all, I am the official timer. You will hear me yell at you when there's 1 minute left, and again, when the presentation is over at the exact 10-minute mark. If you're in the middle of a sentence, you just have to stop, and I'll do that again during the Q&A, so be prepared. Don't be alarmed when you hear me shouting. Second thing is, I want to run over a couple of rules here. The CFA is bound by professional ethics, and everyone participating and attending the competition will be held to the same standard. There's absolutely no communicating with the presenting teams during the day-long competition. Audience members are not allowed to text or email students that are participating in the competition. Because all teams are analyzing the same company, there cannot even be the perception that teams waiting to present are getting information on the teams that are presenting later, or the questions that the judges ask. We understand the need to use your devices for business and ask that you step outside the auditorium should the need arise. Students will be asked to avoid using their cell phones, laptops, or tablets until after they compete. The other thing is, once your team has presented, you are welcome to sit in the auditorium and watch the rest of the competition. We are also this year taping all of the presentations. We're going to make them available on the CFA website for a limited period of time, so all of the teams had the opportunity to watch each other. It's the first time we've done that, so. Now I think it's time to have the teams that are presenting move into their sequestered conference rooms. And in a few minutes, we will get started with the first team up for the afternoon. So thank you all again for coming.
Welcome to the stage, Team Diversification.
Hej, Jenna. Jenna.
Hej,
Jenna.
Nice to so, Hej. Hej. Can we start?
Okay, good. Good afternoon. We are Team Diversification, here to discuss our valuation of Ulta Beauty. Together, favorable revenue forecast, its leading loyalty program, and unique product portfolio drive our buy recommendation with a target price of $292, representing a 15.5% upside. The key drivers for our positive buy recommendation are as follows. We project that Ulta's top line will grow sustainably, increasing by almost $14 billion by 2029. As Ulta's revenues grow, so will market share. Analysts expect cosmetics, which account for roughly 20% of the global personal care market and over 50% of Ulta shares, to outperform. As Ulta's top line continues upward, it will solidify its position as a leading beauty and salon retailer. The first of our three major revenue drivers is demographics. According to market research and our customer survey, the average Ulta shopper fits a displayed profile. Despite an aging nation, the median age of the growing female population, a beauty market tailwind, will remain within the biggest personal care spend bucket. The proportion of single females who will spend more on personal care products is also forecast to increase. Further, as females obtain more education while postponing or abstaining from marriage and motherhood, their disposable income shall rise. Additionally, Ulta has launched new marketing campaigns targeting growing subpopulations such as millennials, Latinos, men, and teens. This, coupled with macroeconomic trends, foretells higher disposable income. Ulta's revenue should also increase through its innovation investments. Amazon currently dominates the rapidly growing online beauty retail market. Ulta strives to increase its online sales through its 2018 acquisitions of Glam Street and QM Scientific, whose AR, AI, and machine learning technology will enhance customer experience. Our third revenue driver is retail sales, both domestically and in Canada, which is an attractive beauty market due to its relatively superior tourism industry and expected beauty retail growth. By 2029, we project that Ulta stores will exceed 1,600.
Two key features protect Alta's revenues. First, Ultimate Rewards providing an extensive and active customer base, serving as a narrow protective moat against its competitors and increasing customer retention and patronage. The second scaffolding is its unique mass, prestige, and private labeled product portfolio coupled with salon services. Its domestic leadership position makes it attractive to numerous buyers and brand suppliers. Comparatively, Ulta's aim to be one-stop shop for all beauty needs is relative in the competitor's relative narrow offerings. Ulta's mix of skincare, hair care, and fragrance makes it tough to find competitors. That said, we believe the closest competitors for Ulta to be Sally Beauty, Target, L Brands' Louis Vuitton, and L Brands' Bath & Body Works, and Louis Vuitton's Sephora. Next, we arrive at our $292 12-month target price using two valuation methods, looking first at the most important assumptions used to forecast our financials through 2029. Our main revenue drivers are new store construction at 70 US and 14 Canadian stores, same-store sales growing conservatively at 2.2%, and e-commerce growing at management's annual target of 30%, reaching 50% of sales by 2029. For these sales, Ulta must invest in new and maintain its existing stores. Additionally, to drive traffic online, we expect Ulta to continue to acquire cutting-edge tech firms. Using a recent industry acquisition as a proxy, purchases costing just over 7% of sales should occur every 18 months. As sales transition online, we expect a corresponding increase in the gross profit. Estimated production costs are a weighted average of its implied store versus proxied online costs weighted by annual store versus online sales. With an increase in online sales, we anticipate a decline in inventory days. To support higher online sales and to sustain previous tech acquisitions, Ulta must invest in R&D, which we proxy using tech firm Grokstyle's R&D. Finally, we anticipate Ulta to continue to repurchase its outstanding shares at its historic rate. After forecasting our pro formas for our first valuation method, we consider Ulta's relative and historic enterprise multiple, which suggests a 12 times forward EV/EBITDA ratio. Pairing this with our forecasted EBITDA and net debt gives us $297 12-month target price. Next, in our three-stage DCF, we combine our 10-year forecast with a fade stage where FCFF growth decreases linearly over 5 years, followed by a perpetual growth. Discounting our cash flows at a WACC of 8.5% based on 9.5% cost of equity and 2.4% cost of debt gives us a target price of $288. Our team equally weighted both analysis and issued a buy recommendation with $292 12-month target price. This fair valuation represents 15.5% upside from its annual close at $253, significantly beating the expected returns of S&P 500 at 1.4%. It is also implying a very reasonable 2020 PE and enterprise multiple. Finally, we check the sensitivity of our fair valuation using multiple techniques, and all of them indicate $292 to be reasonable.
We next dive deeper into Ulta's historical and projected performance. Overall, our buy recommendation is supported by increases in margins, efficiency, turnover, cash, and capex. While Ulta may experience temporary and superficial downside effects as leases hit the balance sheet, we don't expect any significant impact on its operations. Profitability has been a strong tailwind for Ulta, trailing only Louis Vuitton in its peer set. Any cosmetic sales pullback should be offset by its efficiencies for growth program, resulting in rising margins. Although near-term EPS may temporarily dip, it should quickly rebound. Decreases in ROE stem from falling asset turnover driven by growing cash, along with a sudden bump in equity multiplier as leases hit the balance sheet. With its massive store footprint, Ulta can showcase a huge amount of inventory, making turnover a critical KPI. Over the last 10 years, its inventory days have increased significantly. Innovation investments driving more customers online should push levels well below its competitors. Ulta's main liquidity needs stem from inventory, which churns most during its busy holiday retail season. Any working capital requirement, historically more liquid than its peers, are forecasted to improve. Any short-term financing needs should quickly stabilize, and unforeseen liquidity demands could be met internally through its growing cash balance or its untapped $400 million revolver. Alta's long-term financing needs should be funded by its operating and free cash flows. Specifically, store expansion and external acquisitions should push capex as a percent of sales above historical levels. Alta should continue using share repurchases to return value, but will have to scale back to fund acquisitions. FASB required companies to record long-term leases as long-term debt. Consequently, although previously Alta's LTD to asset had been 0%, well below its peers, leading to a favorable Altman Z-score and no debt rating, Alta was forced to add a significant amount of operating leases as long-term debt and net PP&E carrying value. Despite the sudden increase in debt, we anticipate that this measure should quickly stabilize. Finally, our valuation could be impacted by the following forces. While we identified many risk factors, for brevity, we will focus on 3. Alta's limited exclusive product mix does not differentiate it from other beauty retailers vying for customers. However, its loyalty program does deter some customer migration. According to Global Risk Report, technology issues rank highest among corporate concerns. To maintain its leadership, Alta must invest in AI and AR, overspending technology-specific investments of worldwide retail companies. Alta is extremely vulnerable to its vendor partners' performance, product decisions, and sales channels. However, given the breadth of its partner relationships, the impact of any single vendor on Alta's operations is minimal. Finally, Alta's revenue growth, bolstered by demographics, innovation, and retail sales, while being protected by its loyal customers and unique product mix, drive our buy recommendation. We would now like to open the floor for questions. Thank you.
Well, thank you. Very nice presentation. I would like to draw attention. You had a few references to R&D. And could you kind of break out for me how much of that R&D is factoring into your analysis that is tech-related, and how much R&D is product-related? And any I guess, feedback you can give us to understand that would be appreciated.
Okay. So right now, we are proxying the tech acquisitions using tech firm Grok Styles R&D. Alta currently has Glam Street and QM Scientific, but their acquisition costs were not disclosed. And neither was L'Oreal's similar recent purchase of Multiface's augmented reality platform disclosed. So we've proxied the tech acquisitions using tech firm Grok Styles R&D. And for the product R&D, we have chosen Estée Lauder's Estée Lauder to proxy the product acquisitions. Estée Lauder. Yeah. Estée Lauder is one of those companies which has the most, which is very active in terms of tech acquisitions and technological issues.
Thanks.
Could you speak to the customer surveys that you show in the appendix, as well as your retail visits, and kind of what that analysis helped inform as it relates to your overall conclusion and investment thesis for the company?
Of course. So our customer survey and specifically showed a lot about their rewards program and the patronage that it had. It also showed a lot about the demographics. With regards to the millennials, Latinos, men, and teens that were being targeted. A lot of our survey respondents that we had were actually, we had a lot of men respond to our survey, which we found to be surprising. And one of Alta's differentiators was their price, which put them as an outlier for why people were going. This was us going to our company visit, so we visited one of their store locations, and we were able to test firsthand their prestige in mass and private label products. I personally went to their brow bar, their Benefit Brow Bar, and had some of their services done, and was able to see their products firsthand.
In terms of the revenue growth, I think you've got about $14 billion of revenue growth over this 10-year period. Roughly $10 billion of that growth comes from e-commerce. As they shift to being a little bit more of an e-commerce company, what happens to their bricks and mortar business? And also, do you think they can maintain the relationship between their clients as they move more online?
Sure. So the relationship that they're going to have with their e-commerce is not the target market that they're reaching with their e-commerce store is not necessary. It's a new market. So they're reaching customers that are currently shopping on Amazon and other online retail beauty markets. They're not cannibalizing themselves. So they're either taking they're making them omni-channel customers, or they're taking them from another source. They're not going to diminish their brick and mortar stores. Do you have any more?
Yeah, so the essence of the point is that we are not disturbing the customers that are already coming to the brick and mortar stores. We are just focusing right now on tapping those customers which are not shopping with Ulta online.
What do you think will be their competitive advantage then versus that customer that's currently going to Amazon?
I think that their competitive advantage would be that Ulta is purely a beauty store versus Amazon, who is mainly a tech retailer. They have every kind of technology. They have every kind of retail available, and versus Ulta, who is purely beauty, hair care, skincare salon.
Also, since it's a beauty industry, the returns of makeup is one thing that bothers all the customers. We don't really think it's as easy as Ulta. Like, the returns are not as easy when it comes to Amazon as they are for Ulta. We even checked this policy when we were doing our company research, though the people were very, very opening and very welcoming to take the returns. We really don't think Amazon would be as welcoming and as happy to take the returns. So this is one of the cutting-edge things that Ulta has, which Amazon does not.
What is your assumptions imply for ultimate market share for Ulta in the U.S. market as well as in Canada? And how should we think about that over the long term?
I'm sorry, I didn't understand the question.
What are your assumptions? So I think you're modeling 26 billion in revenue at the end of the forecast period.
Mm-hmm.
What does that imply in terms of market share for Ulta, and how should we think about that in regards to both the e-commerce channel as well as the retail?
Okay. So right now, Ulta has not really went into Canadian economy yet, but it is planning. Its 10K discloses that they are going to enter with 14 stores in Canada. There would be an increase in the market share, of course, and this is why we expect there would be an increase in the share price as well. We have also forecasted all the ups and downs that can happen when they're expanding in Canada. We've built in e-commerce as well. Currently, it is trading through border-free, but if anything happens with border-free contracts, they can always move to Intershop, Accenture, or Equity also. Like, these are the competitors for border-free. So the picture looks bright for Ulta in the future, yeah.
Going back to the competitive risk conversation, you mentioned that no one supplier is significant enough to really derail the growth story, but as we contemplate what may change in the e-commerce world, are you worried about direct channel competition, vendors going direct online and circumventing Ulta as a distributor?
So so Ulta is a unique shop for both mass and prestige products. And what is differentiating between their online and their brick and mortar stores is that in their brick and mortar stores, people can try out the samples and test. Whereas in that through the e-commerce platform, that's not entirely possible. So we anticipate that this. Though Ulta moving into e-commerce and other beauty retailers supplying out through e-commerce, it's still okay because, first of all, Ulta's employees are well trained, and they through our company visit, we had like first-hand experience with their employees where they kind of educate us. This is not possible through the e-commerce channels. But to continue
off of that, the suppliers will not be able to have a direct connection because with Ulta, you're able to shop through those multiple brands. And by having the direct connection, you're not able to have that variety. So with Ulta, you have that free shipping after $35, and after spending on 2 different product brands, you would be able to have that, whereas if you would go straight through direct suppliers, you'd have to pay for separate transaction shipping, which would make us a stronger competitor.
How should we, just a follow-up on the e-commerce, if you think about Instagram as a platform and the ability to shop and this experience you can have with that, or different, or YouTube and their ability to people to trial products and then link directly from there, how should we think about the positioning of Ulta relative to some of those opportunities that we anticipate to emerge over the longer term?
So there are a few beauty enthusiasts who do that already, but then Ulta, for that, we have like Kylie Cosmetics that is supplying through Ulta. There's KKW that's supplying through Ulta. So that's how we think Ulta will be able to bridge that gap. Ulta is also opening its product line to. So Ulta is also investing in Ulta is also investing in AI and AR. So if the customers want to go through that, Ulta is still doing well.
Moreover, Ulta is currently attracting the beauty enthusiast and not a normal customer. So these beauty enthusiasts would make sure that they are putting in Ulta's name in their promotions, and they are helping Ulta marketing.
You model a pretty significant step down over time in the cost of sales and a bump in gross margins. What was your thinking behind those assumptions?
COGS. Can you please repeat the question?
There's a significant improvement in the cost of sales over time. So what's driving that qualitatively?
Okay. So the tech acquisition is driving the sales upwards. Currently, Ulta has 2 augmented reality platforms, which is already driving the customers up. Their returns policy, their product diversification, their massive store footprint.
Okay.
Thank you.
Welcome to the stage, Team Appreciation.
Good. Mass and prestige. Most beauty companies would sell either of these two product types, but there is one destination that offers both with unparalleled product type and full salon services. This is Ulta Beauty, the largest beauty retailer in the US and the market leader in the specialty retail industry. Ulta secures a market cap of over $16 billion, a free float of over 94%, and captures a solid stock growth of almost 1,400% in the past 10 years. We, Team Appreciation, issue a buy recommendation for Ulta at a target price of $333.47, a 17% upside for three following reasons. One, strong competitive position backed by innovation makes Ulta the consumer's first choice in beauty. Second is its visionary growth strategy that fuels steady growth in the long run. And finally is Ulta's ability to deliver long-run profitability.
So let's first dive into Ulta's strong competitive positioning. Capturing 7% of the $87 billion beauty product market, Ulta is the industry's innovation leader on the physical, emotional, and digital levels. Ulta has completed 12 remodels in 2019 and added the skin bar feature to 20% of its stores, greatly improving their physical in-store experience. Moreover, the acquisition of QM Scientific and Glam Street and the launch of the Virtual Skincare Beauty Advisor have led Ulta's digital innovation, advancing its personalization with more AR and AI offerings. Cementing this solid innovation is Ulta's winning loyalty program, Ultimate Rewards. With 34 million active members, the program has already captured 1/10 of the national population and represents more than 95% of the company's total revenue. With the increased innovation, Ultimate Rewards creates an engaged clientele that we believe will enable Ulta to deliver a steady 8.6% average revenue growth. Finally, unlike other beauty companies, what differentiates Ulta is its masstige product offering. Ulta officially covers all price ranges alongside a full-service salon in each brick-and-mortar store for hair, skin, and brow services. With such a differentiated business model, Ulta provides an all-in-one beauty experience that is unique in the specialty retail industry. We expect Ulta to outperform the industry's benchmarks in regards to EV over sales, EV over EBITDA, and PE multiples in 2020, propelling market share gains for Ulta.
Supporting Ulta's strong competitive positions are three growth strategies: strategic partnership, supply chain enhancement, and consistent store expansion. Ulta has partnered with 500 brands, which aggregate to 97% of its revenue. In 2019, the company has added 30 more skincare brands, capturing the consumer spending shift from makeup to skincare. We expect this strategic partnership to continue, setting the skincare revenue to be 22%, a 100 basis points increase. Moreover, Ulta also partnered with digitally native brands from celebrities such as Kylie Jenner and Millie Bobby Brown, which will drive more sales from millennials and Gen Zs, and put Ulta in a strong competitive standing with Sephora and Amazon. In terms of supply chain, Ulta plans to accomplish its 2-day shipping goal by 2021. So how exactly can Ulta achieve this? Ulta is ramping up the Fresno distribution center, fulfilling 22% of its e-commerce orders. In addition, the opening of Romeoville Fast Fulfillment Center will enable Ulta to fill 30,000 e-commerce orders per day during peak time. This will reduce the cost per item shipped by 25% and result in a consistent e-commerce comp growth by 25%. Finally, Ulta envisions opening 80 physical stores per year for the next several years, which will greatly enhance its omnichannel capabilities. These strategies will also allow Ulta to maximize its capacity in the US and drive a comp sales growth of 6% in 2020. Plus, with the upcoming penetration to the Canadian market, Ulta is set for future growth.
On to the final point.
We credit Ulta's long-run profitability to three main drivers: robust revenue growth, increasing margins, and strong cash flow generation. We expect Ulta to increase their sales by 8% over the next 5 years as a result of their attractive loyalty program, their market-oriented product mix offered over a variety of mediums, and their consistent annual store expansion. Over the past 10 years, Ulta has posted an impressive revenue CAGR of 18%, which can be directly credited to both their investment in e-commerce and digital innovation. We firmly believe that becoming an efficient omni-channel retailer, as well as capturing more market share, will be critical for driving sales growth for the coming decade. Ulta has also cut their cost of sales by 5% over the past 10 years in an effort to increase operational efficiency. We believe that with their cost optimization program and increased distribution capacity, this will help drive Ulta's operating margin by 140 basis points. It is also important to note that Ulta is set to have an average EPS increase of 9.5%, as well as an average cash flow generation increase of 15.5%. Finally, we recognize the change in balance sheet recording practices as a result of the new accounting lease policy, and we believe that this will help increase Ulta's ROE. With increasing margins, healthy financial leverage, and efficient use of assets, we expect Ulta to increase ROE by almost 700 basis points through 2024. This is indicative of both Ulta's long-run profitability and increasing shareholder value.
So, with strong competitive position, visionary growth strategy, and long-run profitability, we arrive at a buy recommendation for Ulta at a one-year target price of $333.47, representing a 17% upside. As Ulta doesn't have any interest expense, we use a discounted cash flow to firm model with a WACC of 7.3% and a terminal growth rate of 2%. Specifically, our WACC is based on the US 10-year Treasury yield and the capital asset pricing model. Meanwhile, our terminal growth rate is determined by three aspects: the US long-term inflation rate, the US real GDP growth rate to 2026, and the beauty and personal care industry CAGR to 2023. In addition, as Ulta has posted phenomenal EPS growth in the past decade with a CAGR of 26%, we believe PE multiples are very crucial in analyzing the company. We notice that Ulta is currently trading at a discount compared to a historical PE in the past 10 years, which is indicative of Ulta's earnings increase and supportive of our buy recommendation. Finally, due to the lack of publicly listed specialty retailers such as Sephora and the lack of beauty-specific data from well-known retailers such as Walmart and Target, our peer analysis was highly affected. We believe it is very hard to find a list of comparable companies for Ulta in this highly fragmented market. As they did not relatively reflect Ulta's growth, we decided to contribute zero weight to this relative valuation methodology.
Along with the buy recommendation, we acknowledge that Ulta may face imminent business risks. First, innovation headwinds. Beauty and personal care is a constantly innovative industry. Ulta is currently suffering from the headwinds, which have not driven expected growth. But by the end of 2020, the makeup category should be on the rise again due to the 4 to 5 year duration of the cycle. We expect a rebound for Ulta in 2020 because of the company's strong management guidance and continuous innovation as a market leader. Second, the coronavirus outbreak. The coronavirus has been deemed a global health epidemic and has raised uncertainties across retail industries. Should the coronavirus become more prominent in the US, Ulta's two-day delivery strategy will be largely affected in addition to the possible decline in overall consumer spending. However, Walmart and Target will be the most susceptible, whereas Ulta poses as lower risk due to supply chain and operations. Finally, taxation risk. With the 2020 presidential election underway, a change in leadership may result in an unfavorable corporate tax rate for Ulta. After running a sensitivity analysis with a 28% corporate tax rate, we still hold a buy recommendation for Ulta, representing a 9% upside. Another mitigating factor is Ulta's high EBITDA margin of 17%. We also attribute Ulta's growth to strong corporate governance, as indicated by the low ESG score of 17. More importantly, CEO Mary Dillon, who was recently named chair of the board of the Retail Industry Leaders Association, has been critical to Ulta's growth since 2013. With strong competitive standing, visionary growth strategy, and long-run profitability, we issue a buy recommendation for Ulta representing a 17% upside. We invite you to partake in the ultimate investment, where the possibilities are beautiful.
Thank you.
Maybe to start, you had mentioned that part of the rebound that you're expecting for 2020 was based on strong management guidance. Maybe you can provide more details around what that management guidance is and what gives you confidence in it.
We believe that the strong management guidance circles around Mary Dillon and her team. Mary Dillon has been in charge and has successfully implemented their Ultimate Rewards program and their in-store experience, as well as the omnichannel marketing. We believe that Ulta will experience this rebound because they can depend on that corporate guidance and the management guidance from within to implement and to continue to strategize and adjust, even if it's their product selection or how they reach consumers. We believe that that's what we mean by the strong management guidance.
In addition, I want to add that during the Q2, we saw an earning miss for Ulta, but as a result, we have seen a certain action from the management guidance where they lowered their guidance for the year, which will be indirect with Ulta's growth in the future.
Also, it is a fact that Ulta has been showing healthy financials right after Mary Dillon came into the CEO position in 2013, and also has been keeping up with all the trends and how the industry keeps changing. So this is also a factor which determines how strong the corporate governance is.
Why do you believe that this headwind that you label as a soft cycle of innovation is kind of a temporary thing, that it will end in 2 to 4 years? Why don't you believe it may be a longer-term trend of more movement from cosmetics to skincare?
So we believe that this headwind is just temporary because of like the importance of cosmetic. We did a field work, and our respondent rate skincare as important. They rate cosmetic as important, and skincare is really important, very important. So we believe that skincare makeup will come back in the future, just in the short term, in the near future, and skincare will continue to grow. Not because the comeback of makeup will lower the growth of skincare. So like for me personally, I use makeup occasionally, like today, but I need skincare like every day, twice a day. So I believe that they are both important, and makeup will soon come back in the future.
How should we just think about the industry growth rate? I know there's some cyclical softness in the makeup category, but how do we think about the long-term industry growth rate, and what do you guys forecast for that? And then how do we think about Ulta's ultimate market share, or what that could peak out at?
About Ulta's market share in the industry, Ulta has currently has 7% of the $87 billion beauty product market. However, there is still room to gain market share for Ulta because of how much it differentiates itself from other competitors. It gives a unique on-one experience. No one has that except Ulta. So we believe that with additional, again, corporate governance, as well as all the differentiation that Ulta has, and also how it plans on expanding in the future for Canada for even more gains, the market share of Ulta will definitely rise in the future. And about the cosmetics, we believe that we've seen a trend on how every 2 years the cosmetic industry would have an effect on companies in the specialty retail. There's going to be 2 years of deceleration and 2 to 3 years of acceleration. And that's what makes us believe that this is definitely cyclical, and the cosmetics market will definitely bounce back and give Ulta more market share as well.
Just to add on that, Ulta plans on opening 80 stores per year in order to capitalize and gain more market share. as well as they have their omni-channel capabilities, as Hussam just mentioned. So we see their in-store experience where you have the beauty bar, the brow bar, and that is unique. And then you also have their online shopping experience, which will, as trends keep going more towards online shopping and getting your package in 2 days, Ulta's also working on their digital innovation and e-commerce sales as well. And then finally, they have their buy online and their in-store pickup as well. So you can kind of get the best of both worlds with that and have the ability to experience the in-store once you purchase that.
Can you help me understand how the narrative you guys just provided ties into the numbers? I think your DCF stops 5 years out. So from the narrative you're providing, it seems as though the growth runway is much longer than 5 years before it would grow. I think whatever your terminal growth rate is at, I'm thinking around 1.5%, 2%, I'm forgetting. But how should we just think about that, the narrative you provided relative to the numbers you're showing on your DCF?
So the reason why we only choose 5 years instead of 10 years is because of the turbulence with the presidential election. We don't know how it will be after 4 years and after the other 4 years. So that's the reason why we want to just forecast the next 5 years. But then also, if you look at the DCF, we believe that this upcoming decade, Ulta will still be growing, but at a smaller percentage and a smaller level, just because in the past 10 years, they have been on the rise, very strong. And we are thinking that Ulta will be reaching its maturity stage coming to this 2020, coming to the new decade. And our DCF shows that we acknowledge that currently the coronavirus is affecting the whole market, and Ulta is also being affected. But in the long run, the stock price will rise up again.
You mentioned that management is guiding for 80 to open 80 stores per year. How did you think about that and the feasibility of that and what that would do to their financial performance, particularly in a landscape where a number of retailers are closing the number of outlets that in terms of their store base?
So Ulta used to opening more than 100 stores per year, but now they lower the store to avoid the saturation.
Adding to that, I want to talk about how Ulta is focusing at omni-channel guests, one that use both the digital experience and the physical experience. And so Ulta lowered their store opening not only to avoid saturation of the market, but because they are investing as well on their digital experience. For example, one of their latest digital offerings that was launched actually last September is Sparked at Ulta, which, as you're going to see, is a 3D version of a brick-and-mortar store that has currently 4 brands in it. This is a new feature that gives. Okay, so you cannot see. However, it's a 3D visualization of a brick-and-mortar store that currently only has 4 brands. However, Ulta is definitely planning to invest more in that. This gives consumers a really unique VR experience that shows how Ulta is going for both sides at the same time.
And I think to build off of that, as indicated by our survey, consumers and customers, they still value the in-store shopping experience as well. Roughly half, or 45%, do the in-store, and then we have the other part that does the online. So to Ulta members, that in-store experience is still important to their offerings, but by having that omni-channel marketing and having that experience, Ulta capitalizes on kind of the best of both worlds scenario.
You did a nice job of really talking about the sales channels and the breakout between e-commerce and physical stores and the impacts on margins in the aggregate and valuation in the aggregate. Did you put your minds to work to try to break out or back into what the margins or what the profitability would be relative to physical stores and e-commerce? Did you try to delve into that at all?
So we definitely thought a lot about how Ulta's financials gonna be in both the digital side and the physical side. And as we saw how the trend of people shifting from brick and mortar stores to online will definitely affect Ulta's financial growth. We tried to do our research and our fieldwork to see how important this trend is, and we noticed that it is definitely important in the industry. And we were pretty pleased that Ulta is actually doing many efforts and investing much on both the sides of things, which makes them in a very safe position for the upcoming trend.
And I do want to add to that according to Vice President of Investor Relations, Ms. Callie Rollins, she did mention.
Oh. Thank you.
Thank you very much.
Welcome to the stage, Team Securities.
Shall I start? Good afternoon, everyone. We're Team Securities, and our recommendation of Ulta Beauty is to hold and buy on dips. Our recommendation price is $284 based on the closing price of January 21st. Ulta Beauty is the largest specialty beauty retailer in the United States. It established its operation in 1990 and has been successfully growing in the past 30 years. It sells more than 25,000 beauty brands to get the amount of these loyal customers. It also has more beauty consultants than its competitors. It has established a wide collaboration as well as exclusive Ulta brands, and also have its own brand, Ulta Beauty Collection. Ulta has established more than 1,200 stores across the country and connect with their customers using an omni-channel strategy to promote their convenience and loyalty. So our forecast of Ulta is based on 3 facts: their efficient business model, their competitive edge, and their management. So it has a strong ability in this industry. Now let's welcome Kay to elaborate on this.
So Ulta operates in 5 segments, all of which cosmetic contributes 51% of its revenue. There was a recent slump in the share prices as the management team confirmed negative growth in these sectors. This sector is cyclical in nature and driven by innovation. So the management participates with suppliers in suggesting change and innovation that can bring back growth in these sectors. The typical new product development cycle is around 18 to 24 months. Therefore, we can anticipate this sector is going to be back on growth in the next following 1 to 2 years. And skincare has high growth rates, as there are more consumers informed about care their skins, to which the beauty retailer responds with successful products. Similarly, hair care is highly endorsed by celebrities, and it keeps the market demand high in these sectors. The salon service is more related to consumer preference, and they will become loyal once they find the right one. Now, Ulta competes across various retailers, but among the beauty specialty retailers, it has the highest market share at 26%. Apart from these competitors, it also faces intense competition from the competitors such as Target, Macy's, etc. Those beauty retailers form a beauty market, which is about $86 billion in US, and Ulta takes a proportion of 7.46%. It actually is a fastest growing retailer. Within the beauty industries, there are high rivalry among the competition, and due to booming e-commerce, new firms can actually pose a threat to Ulta. The supplier bargaining actually is relatively low because there are many vendors competing to sell their products. And the beauty industry as a whole is estimated to be growth at a CAGR of 3% within the next 5 following years. And Aboli can tell us what aspects does Ulta perform better than others.
Yeah. So while the competitors are closing their doors, Ulta has been opening new stores every year. Approximately 58% of their stores are in top 10 most populous states, and 90% of their stores are in strip malls. Ulta has approximately 34 million members under its Ultimate Reward program, which also offers credit cards to its customers. These 34 million members, which generate around 95% of their sales, represent 32% of women in USA from age group 18 to 64. The credit card also encourages its customers to earn reward points and thus building customer loyalty. This also gives Ulta a large data set to work with, through which they can send customized suggestions and promotional offers to the customers and thus growing their sales. Ulta also has beauty expert in each of their stores, which can give insightful suggestions to the customers as per their need. Because beauty product is a discretionary good, Ulta has been smart enough to have built customer loyalty within Gen Z and millennials. Now, as their spending capacity would increase, this would ultimately boost Ulta's sales in near future. Ulta currently has 5 distribution centers, and they plan to open the 6th one in coming year to help them in growing online sales. They have also acquired 2 AI-based companies to improve their online app features. Ulta has opened fast fulfillment center, and they have also started ship from store services to help them with speedy delivery process. Their web and mobile traffic has been among top 3 in the recent years. Ulta's association with exclusive celebrity brands has kept celebrity fans hooked to Ulta. And lastly, with 25,000 different products and 500 different brands, the price range offered by Ulta product has been maximum compared to its peers, and thus making Ulta a store which has something for everyone. Their financials also look good, doesn't it?
Yes, so when you compare Ulta's financial with its competitors, you observe that Ulta has the highest sales per square foot and is growing the comparable sales every year at the fastest rate in the industry. Now, Ulta has the better operating margin, the profitability ratios, and the liquidity ratios in the industry. Even though the gross profit margin is a bit low, Ulta's conscious effort to continuously decrease the operating expense has resulted in Ulta having the best operating margin in the industry. With no interest-bearing debt, the net operating profit is also maximum in the industry. Now, with constant share buybacks, Ulta has been able to pass on this savings to the shareholders in the form of increased EPS, which is incredible compared to its peers. If you look at in the last 15 years, the cash flow from operations have been positive, and the current cash flows from operations is also looking very healthy. Now, when we compare the last 5 years' sales of Ulta, it has grown at a CAGR of around 20%. During this same time, the sales from competitors like Sephora grew at around 3.8%, while Bath & Body Works grew around 7.8%, and in fact, from the other competitor was negative. So Ulta has been successfully doing this, and this is what is helping Ulta to gain market share in the industry when the cosmetic segment is kind of slowing. The fastest growing channel for Ulta has been the e-commerce sales. Now, based on our model, we predict the next 5 years' sales to grow at a rate of 7.2%. This is based on the fact that Ulta is planning to open around 80 stores new year as per the management guidance in US. Based on the cash flow projected, we value Ulta using different valuation methods, and the value which we derived was around $284 per share. Now, we assumed a terminal growth rate of 4% after year 2024, considering the fact that Ulta is planning to go international. In fact, it has already started shipping to Canada last year. Now, this doesn't mean that we completely ignored the comparable analysis, but what we concluded was that Ulta has a premium in the market, and this premium is justified because of the competitive edge Ulta enjoys and the management and the business model Ulta has. Therefore, the value which we derived from this method, we did not give much weightage to that. Now, before making any investment, you should always consider investment risk. Isn't it, Kritika?
Yes. The future projections for Ulta could be negatively impacted if Ulta is unable to analyze the changing trends in the market and implement those in the business. The defaults in strategizing new locations of the stores could negatively impact Ulta's growth. Increased competition in the industry with regards to technological advancements, pricing, and promotional strategies could have an impact on Ulta's growth and could add as an added threat for the company. Along with this, maintaining good relations with brand partners and sustaining the loyalty program customers is important for the company due to its huge impact on the business. In this digital era, social media plays an important role, and Ulta can better tap the social media platforms like Instagram and Facebook for promotions and advertisements, along with tapping the opportunities from the growing e-commerce market. Currently, it is highly important for the cosmetics segment to be back on track for increasing in future sales. We also perform sensitivity analysis by changing WAC and the growth rate and find that our range is between $270 to $290. Along with this, we also analyze the ESG framework of the company, and we see that it has a good ESG framework. Naming a few, majority of its board of directors are independent. They also have written policies in place to deal with related party transactions. After thorough analysis and evaluation, we find that our valuation for Ulta is $284, and we believe that the company is fairly priced in the market. Therefore, we issue a hold recommendation. We also see that the company has a strong business model, multiple competitive edges, and
a good and efficient management that will drive its growth in the future and will keep the company growing and let it remain the cash cow that it has been through the years. Therefore, we also recommend buying on dips for long-term capital appreciation. Thank you, and the floor is now open for questions.
Can you provide some additional details as it pertains to your sales forecast over the next 5 years and what factors underpin that?
Yeah, so we basically kind of did a regression analysis considering the fact that we incorporated all the quarterly data for the last 12 quarters. That way we kind of smoothened the seasonality in this beauty market. And based on the number of stores opened in that phase or that quarter, we kind of did separated the online stores and the stores which were exclusively made through the stores, basically, sales which were exclusively made by the stores. So based on that regression analysis, we predict that this will grow at the rate of 7.2% over the next 5 years. We have also assumed one fact that online sales currently are around 11% of the Ulta's revenue, but this will, since the beauty industry still values, the customers still value human touch in the beauty industry, they will still find and go to stores rather than preferring online. They obviously prefer online, but they will still value the in-store sales. And based on that, the overall market share for online will be around 16% for Ulta in the next 5 years.
What are you guys projected in terms of same-store sales growth, and how should we think about that?
Okay, so basically Ulta or all the basic companies in this industry are comparing the same store. Let's say there's a store over here in Chicago. So they'll compare the sales in the next year, how much it has grown in that. On an average, it has been around 4 to 6% for Ulta. The time frame is kind of 14 months. The store should be operational in the last 14 months in the year, basically. So that is what same-store sales growth is.
Thank you for the definition. How should I think about the growth algorithm if I was to build this up?
Okay.
How do you think about same-store sales growth over a longer time period? How much growth is coming from space? And then how should we think about the growth of e-commerce over a longer time frame?
Yeah, so based on our regression analysis, we kind of incorporated the growing sales per square feet because we kind of did the analysis for the last 12 quarters. The analysis predicts that this trend will kind of keep on growing, and we also incorporated the fact that the beauty industry is about to grow at a rate of 3% in US. So since Ulta still has a market share of around 7.6%, it still has huge potential to grow its sales. And Ulta is also strategically placing stores, like 90% of the stores are in strip malls, right, where there is a larger footfall compared to other places. And most of them are in nearby areas compared to the city center. So Ulta's management is strategically opening stores, which will kind of grow the sales over the years, incorporating the same store sales growth.
Okay. I have some additional comments about the e-commerce, because you have mentioned that we can see the e-commerce like the LinkedIn and other social media, that we know that the Gen Z and after a million these young children and teenagers, they are born in an internet area. It's just like us. So we're more accustomed to search on the internet. You know, I think Ulta is more like an ecosystem or environment to provide the customers with a consuming feeling of that. So when the company learns how to generate this feeling of ecosystem, you know that last year they bought a 2 AI company. That is very fantastic and appealing, I think, compared to their competitors. And for the e-commerce trend, we know that, for example, these years maybe have some consuming decline because of some reason. So I think it is a push to this trend in this industry. So I think that Ulta has already done something for this potential in this trend. So I think maybe after some years adjustment, and then they will meet a high growth in the future.
I kind of want to make sure I'm clear on this topic. So as you build out this e-commerce story, do you believe that in your model that the same store sales will stay at the historical level?
Not really. Cannibalization will have an impact. But I guess we have kind of incorporated that using the polynomial regression and other regression, kind of which overestimated or underestimated the sales if we look back at the data. So we kind of use different weights over the years incorporating our estimation. The same store growth rate will be around at least at the lower end of 4%, if not higher end of 6%, because there is a downtrend in the cosmetics segment right now. If the trend reverses, then yes, there is a chance of increasing the same store sales growth to around 6%. And also, you have to consider the fact that online sales are also being counted in same store sales for Ulta. So they have grown at an incredible rate, but I guess the growth won't be that fast now, the online sales. It has reached to a kind of a level where it will stay constant. Not constant, but at least increasing at a slower rate.
Did you, in your risk analysis, focus at all about the competitive risk?
So, no answer.
It's not jumping out at me in this. It's well addressed in your Porter analysis.
Yes, so we have incorporated the competitive analysis in the Porter's 5-4 model and understood the industry, how the various buyers and sellers have their say in the industry.
Okay.
But I'd like to add one thing that competitors are also, like there was a news yesterday that JCPenney is kind of closing stores and all. So since Ulta has a capital structure or a business model in such a way that it can absorb this slowdown in this segment rather than the other industry, the competitors. So they will kind of face more slowdown compared to Ulta, which in a way, if overall sales are growing, but still Ulta's presence in the market will help Ulta to grow over the competitors, basically.
And Ulta has a premium over all its competitors.
Yeah, because of the competitive edge and the different offering that Ulta has.
How do you think about the sustainability of their competitive advantage, and how do you tie that into the DCF? From the way you discuss this, you say long-term capital appreciation, buy on the dips. It seems as though you're positioned, or you think that the growth above industry will last longer than 5 years or longer than through 2024, but I think you're cutting your DCF off at that point in time. Can you kind of just walk me through how to think about that?
Yes, so basically,
I'll just add one point. So in terms of sustaining their competitive edge, the main advantage which Ulta has over its competitors is the broad price range of the products they offer. So Ulta offers high prestige beauty products as well as the mass market. So that Ulta, among its competitors, Ulta has been seen as a store which has like something for everyone. So that is one of the main advantageous points which Ulta has over the stores. And
yeah,
Also-
and also,
Sorry,
you can.
I want to make a compliment about it. Like, also, like in Ulta, they have the salon service is one of the special part of it. Compared to other like the competitors, they don't actually have this. And a lot of like consumers are attracted by the salon service. So it's one of the advantage of it.
Yeah, and one more point adding to that, since Ulta already has 34 million of the customers attached to the reward program, like Sally Beauty just started it last year, giving credit cards and things. So competitors are moving, but they are like kind of moving it right, slow movers. And Ulta has the advantage of first mover in the industry, and that's why we believe that they will keep on having this competitive edge because of the first mover advantage, basically.
You cite the store preferences by customers in terms of buying beauty products. Is that based on your own analysis, or was that based on a survey that you found?
It was based on survey we found on Forbes newspaper.
Okay. And then as it relates to the sales per square foot, the industry average, what's incorporated within that? What companies within your industry?
Yeah, so we have taken Sally Beauty, we have taken Nordstrom, and then we have taken JCPenney, and we couldn't find data for Sephora because it wasn't exclusively mentioned that how many it operates. We took ELF, but ELF is kind of online sales, so it doesn't have any store sales right now. So
We've taken Macy's.
yeah, Macy's also.
And then can you talk about capital allocation, what the firm does with its cash, and whether you think those are good uses of cash or not?
Yeah, because major cash has been used over the years for the share buybacks. Like they have been buying back shares in the last 6 years, and you can see the share buyback amount has been increasing over the years. So I guess firm believes that it's a good reinvestment in itself. It's at a cheaper price, even though this year they kind of found it an expensive deal because they bought majority of shares around 320 level, and right now it is currently at a way more discount average. But yeah, okay.
Thank you.
Thank you.
Thank you.
Thank you.
The last team of the afternoon is Team Index.
Thank you. Hey, good morning, everybody. Hope you guys have been having a great day. We are Team Index, and my name is Eric Christopherson.
My name is Jacob Flynn. I'm Noah Owens.
I'm Tiffany D'Amato.
And we are really excited to talk to you guys a little bit about Ulta. We just want to kind of take you guys through our investment rationale. So starting off, the first thing that we look for while we are looking at a potential company is their mission and values. And Ulta, their mission is to empower every single person that walks through their doors, if that's a guest or an associate.
Ulta's vision is to be the company that it's the go-to. They want to be the first company that pops into a client's head when they run out of mascara, run out of face mask.
Ulta's values are ultimately to make sure that their mission and vision are centric to every decision that they make.
So we recommend a buy for Ulta Beauty products. Starting with a valuation date of January 17th, 2020, and a current price of $272.89, we calculated a target price of $289.56, leading to an upside of 6.11%. With that being said, we feel that is a strong yet conservative buy. So these are the strongest reasons why we believe you should invest in Ulta. Starting with it is a market leader in all things beauty. For the past 30 years, Ulta has dominated the market in the beauty sector, being known for their premier products, vast array of brands, and high-quality services.
Ulta Beauty is an unleveraged company, meaning that they have no debt. This means that they're a very conservative buy to add to your portfolio.
Thirdly is the Ultimate Rewards Program. The Ultimate Rewards Program has been part of Ulta for years now. And last year it has accounted for 95% of their sales. And going forward, we believe this is only going to grow. So for a little background, Ulta Beauty was founded back in 1990 and is located just down the street in Bolingbrook, Illinois, and continues to dominate the beauty sector.
Whenever investing in a company, you always want to look at the corporate governance of that company. These are the things that make up Ulta's corporate governance, and I want to hit on the bottom three. First one, code of business conduct. Ulta believes in doing what is right. Next, animal testing. While Ulta themselves do not animal test, they do hold products within their stores that you can buy that do practice animal testing on their products. And last, their environmental impact. Ulta tries to minimize their environmental impact as much as possible to ensure for a safer, healthier, long-lasting world. There are four main strategies at Ulta. The first one being growth. Ulta targets individuals who are between the ages of 18 and 29 and are primarily women. The second one is loyalty. 95% of their sales last year came from loyalty members. The third one, experience. When you go into Ulta, you have certified employees, you have an amazing salon, you have a variety of products. It's a great experience when you go there. And last, efficiency. We read in their 10K that they have this optimizational program that they are going to practice in the next coming years that is going to save them between $150 and $2 million for the next 3 years to come.
So looking at the market, the beauty sales in 2018 in just the United States alone accounted for $145 billion in revenue. That's making up from a lot of different companies, but some of the biggest competitors to Ulta being Amazon, Sephora, Walmart, Target, and Walgreens, with the bottom three being very much these convenience stores where a lot of people outside of Ulta's preferred target audience already kind of know what products they like. They don't need to go to Ulta to get this experience and try out new things. They already know what they want, and so it's really easy for them to just add on that additional purchase at some of these locations. Looking at the PE ratios between Ulta Beauty and the industry averages, you notice that the PE ratio for Ulta is about half of what the industry average is for consumer discretionary. That means that Ulta is very undervalued.
And just highlighting a few of the different ratios that Ulta has over 2019. So a really important one is that gross margin of just south of 40%. It really just shows that they're being very efficient with their money, and they're making a good dollar off of all the money that they have. Another one that I really want to point out is the beta. And it's, as you can see, it's just over 1, so it's slightly more aggressive than the S&P 500. So like we were mentioning before, it is a more conservative investment, but it would be able to provide that good addition to that portfolio.
As you can see here on this beautiful chart, this represents Ulta's free cash flows. The line here represents that their
expectations or their average, and they've outperformed that. They have consistent growth within the last few years.
Ulta has a lot of risk. Looking at some of their global risk, they look to move into the Canadian market. One, that'll create a lot of risk in terms of just consumer preference in the Canadian market. How will people react to having this very brick and mortar store for these beauty products in Canada, as well as foreign exchange risks? Looking more domestically, we see consumer trends leaning more towards a favor of anti-animal testing. Obviously, Ulta doesn't do animal testing on their own products, but they do offer animal testing products in their stores. And that could be very detrimental as consumers lean away from stores that have these sort of products in them.
So for our SWOT analysis, with each of these categories, we came with 3 major points that we thought were really fitting. So starting with strengths, it's the Ultimate Rewards program. As stated earlier, it's at the heart of Ulta Beauty and accounts for 95% of their sales. Second is it's a staple store in the U.S. When people think beauty, they think Ulta. Convenience, it is located in major cities and towns, making it easy for anyone and everyone to get the Ulta experience.
So looking at some of the weaknesses, the first one is a lack of spa growth. So their spa started up a few years ago, taking about 1/10 of their square footage in each one of their stores. And they were really hoping that this would be a really great source of revenue for Ulta. But unfortunately, there's not been as much growth as they have been, as they anticipated. They have struggled with bringing new customers in that will go from their existing salon and move over to Ulta. The second one is their e-commerce site. So their current e-commerce site, it has not been as successful as they hoped, as many people prefer to be in store. And a lot of people would look at this as an opportunity, but we're actually looking at it as a weakness, because a lot of those customers who would shop online and know what they want, they would be taking the revenues away from what are currently existing in the stores and putting them online. And then also a lot of what is within Ulta is that it's a discretionary product. For some people it's not, but for the majority of the consumers, it is a discretionary item.
So for the opportunities, first off is international markets. And what we mean by that is based on their low amount of debt and cash flow on hand, we believe they could move to other markets such as the Canadian market, European market, and other markets as the years go on. Second and third is the male and senior citizen markets. While we recognize this has already been tapped, we feel that it can only be further tapped as the years go on.
So looking at some threats, the first biggest one is external e-commerce sites. So the most prevalent one is Amazon. And they have taken market share from just about every single company within the United States. And that is especially true for cosmetics. Over the last few years, it has been one of their fastest growing industries underneath Amazon. And within specifically, over the next 5 years, they anticipate to double their growth. Another large threat is obviously an economic slowdown that would hinder just about any company, but especially Ulta, as a lot of their products are that discretionary product like we mentioned earlier. And then another threat is new entrants into the beauty industry. There's a lot of smaller stores and just like little do-it-yourself shops that will start up on Instagram, for example, and they can sell a certain kind of product with very little barriers to jump over.
So looking at our valuation methods, we wanted to use 3 different models, EBITDA, growth, and revenue models. Obviously, we wanted to weight them all fairly equally, but we did give a stronger weighting to the EBITDA model due to kind of the rationale. We thought it was a little bit more comprehensive and credible. Moving on, within each of those valuation methods, we used 4 different market scenarios. We wanted to see kind of the range of different scenarios and performance metrics in the market to make sure that we had kind of the full picture while we're looking at our valuation.
Looking at some of those specific calculations, so we started off in 2019 with kind of like their base revenue, and then we carried in future projected for the next 5 years to further come onto these outcomes. And this is all on a 5-year basis. So as you can see, under each one of those assumptions, you can see that over a 5-year basis, we anticipate that there's going to be some really great intermediate growth, and especially for like that, we would value it as a good 5-year investment.
So with that being said, we issue a buy on Ulta, as we stated in the beginning. We think they're right now significantly undervalued. It'd be a great time to get in. We also believe that they're going very high up in the next few years here and have a great chance of producing fabulous returns.
Thank you.
Could you speak to the difference in the revenue growth assumptions between the mediocre performance and the good performance, and qualitatively what's driving the variations in that forecast?
Yeah, so I could take that question. So kind of the way that we differentiate the two, we kind of looked at it from like a historical standpoint in periods where they weren't as successful, but where they still had some growth, but it wasn't extremely successful. So so there's not too much of a difference, but a lot of the main difference is within the revenue percent growth.
Just to piggyback on that, my understanding is that one of the attractiveness of the categories is that this is an affordable luxury. So when someone, or when we go into a bad economic time, someone may pull back on buying a Louis Vuitton bag, but they'll treat themselves to a $20 lipstick or a $30 lipstick because they feel good about the purchase. How do we think about that type of dynamic playing out in your numbers, particularly I think in your bear case scenario, I saw some negative revenue growth, but how should we think about that, particularly given that it seems like they're taking share and still opening new stores?
Sure, it's a hard question to tackle. Obviously, a lot of people that are consumers of Ulta might even tell you that, hey, it's not even a discretionary item. Like, I don't care if the market's not doing well, I'm gonna go and buy these items. So that was definitely hard, taking that factor in, because we ended up kind of coming to the rationale of if it's truly kind of working into more of a recessionary economic crisis, obviously this is definitely a discretionary item, as I think it's even mentioned in our weaknesses. With that said, obviously, we have to assume that people will not necessarily be buying as many goods in one of these circumstances, so it definitely really hurts their growth. Really is going to hurt their bottom line as people shift away from these things. But again, it's a hard assumption to make because it's hard to tell if people will actually cut away from some of these products, depending on kind of where exactly the market's at.
Given the business was founded in 1990, as a means by which to kind of inform that analysis, did you look back at past recessionary periods to see what happened as it pertains to their sales and profitability, traffic, same-store sales, to kind of influence your expectations going forward?
We didn't. I can answer that. We didn't go that far back, as I believe they went public in the early 2000s, and I think we started looking at a lot of that data around 2005, and we were able to take a lot of that data to make what we ended up coming to.
So did you see sales materially decline in 2007, 2008, 2009 when we had the last recession?
Yes, there was a smaller decline. It wasn't as significant as we expected there to be, though. And I think a lot of that, and outside of sales, they were able to cut back on a lot of their expenses, especially in that time, which I think can further shows that they know how to make it through a recession, especially as a discretionary product, and kind of just move forward through that and have some good leadership.
I think you mentioned that you build into your model maybe 150 to 200 million of cost savings.
Mm-hmm.
I think it was based on management's statement that would occur. Do you know specifically what those cost savings are related to, and do you believe management can achieve them?
To the specific of what it's to, no, I do not remember because it was at the time we wrote this paper and schools happened and life's happened a little bit. So no to the specifics, but yes, I do think it's definitely manageable to reach. I mean, I think any company could take precautions to cut back and to switch their motive to something else and be able to save a lot of money, especially if this is in their plan and this is something they're thinking about. It's obviously something they're able to do.
So help me out here with your market conditions. You really didn't pick a market condition. You have a little bit of everything, right?
Mm-hmm.
A bull case, a bear case, and the like. So I just wanted to confirm that we got a little bit of everything being weighted here. And then when you get to the bull market data for 21, 22, 23, you have some fantastic growth I guess estimates, 18%, 28%, 17%. Can you tell me how you got to those high percentages?
Yes, I can touch on that. So first, to confirm what you said earlier, yes, with those, we had those 4 different assumptions, and we really wanted to have a comprehensive idea for what we could project it to. and just so we could get the most fair assumption. Because we can try as hard as we want, but we won't be able to estimate what the economy will be like in a few years. But then to address your second point, yes, so we had some really high growths, and while that seems extremely high, especially for their revenues, it isn't that crazy, especially when you look at their past 5-6 years for their percent growth for their revenues. There's some very, very high numbers in that. I don't have the exact numbers on me, but it equates very similarly.
Yeah.
And I guess because I have to ask as an analyst, why is the bull case in 2020 less than the good case? Is there a reason? The growth is actually higher for revenue in the good rather than the bull.
I don't remember.
Is that
I'm
an
sorry.
oversight or?
I don't believe so. I think there was more of a rationale of to kind of bringing up into getting to where this kind of bull almost exceeding market expectations is kind of how we kind of internally define that. Whereas good is kind of there and the mediocre is, you're just getting kind of better than bond performance, and recession being kind of at that. And I think it really ties into one of the questions that was maybe 2 or 3 questions ago. How are you going to predict these markets? Obviously, yeah, as you pointed out, we used 4 different market scenarios because, we can't predict the market. And with that being said, looking at historical analysis, obviously we're going to take that into account, but it's not necessarily going to be 1-to-1 ratio looking at 2008 to looking at today and seeing if, hey, we're not looking at great financial times, but who's to say the bull market's not going to continue? So.
Thanks.
How should we think about the duration of their competitive advantages? I know you touched on the industry analysis and their competitors. It seems as though Target, Walmart, Walgreens, they've all taken steps to improve their omni-channel offering as well as focus on beauty as an area. So how should we think about this?
Can you restate the first half of that question, please?
How do we think about their competitive advantages or just the duration and the duration of how long that could last, given that some of their competitors are stepping up their omni-channel offerings?
Yeah, I think it comes down to their brick and mortar stores. Essentially, the way the store is designed is set up as an experience, where those other stores is you come and just buy the products and leave. So with this, you get to come in, you get to try on different makeups, you can have the salon services if you so choose, and for the couple stores that do have it now, spa services, and you have adequately trained staff to help you pick and choose things, whether you're first starting off or there's new products, you'll get all the information you need. So they're still staying at the top there, while maybe other companies are getting similar products. I think the experience is what's going to sell them as a brand.
Yeah, to tag on to that, I think 95% of their revenues are from their rewards program. People that are coming in very, very often. So looking at threats to kind of their competitive advantage, obviously Amazon, if people ever start to lean away from this brick and mortar experience, I know they had 2 acquisitions in the past year of IT and VR companies, Glam ST and one other one, I'm sorry, I'm forgetting the name of it. But if some of these VR technologies are integrated into the website and people are able to try out makeup tones and see kind of these things without ever having to go into the store by just using their iPhone camera, that'll definitely cut out a rationale to need to go to the brick and mortar store, and you might just buy these products online and most likely through Amazon.
As they're growing their store base, how did you think about their profitability, and how do you think that they can, are they making more investments, or are they being able to leverage those costs? How did you think about that?
Yeah, so they are, like we were mentioning earlier, since they're like an unleveraged company, they have like an insane amount of cash on hand. I think it's, what was it, 400 million we were reading earlier. And they've been able to tackle all these new stores throughout the United States, and they're now starting to go up to Canada while without taking on any additional debt, which has been quite a feat in itself. I think that they're going to be able to continue this rate of growth for their revenue while they continue to do that without having to add on additional debt. I'm personally a fan of adding on, making a company leveraged, but it definitely, while it may hinder some growth, I think it definitely creates, like we were saying, that good conservative investment into a portfolio. Thank you so much.
Thank you.
That concludes the team presentations. Please return to the auditorium at 3:15 for the announcement of the winners.